we are trying to cover the global financial crisis and COVID crisis, monetary policy implementation. When we refer to global financial crisis, we are trying to describe the condition in 2008, which started with the Lehman Brothers collapse in the United States, and then the global central bank take measures to recover the economies, especially in consumption side. And after the Lehman Brothers collapse in 2008, approximately during 4 years, all central banks, but the leader is the Federal Reserve Bank, try to increase the consumption and demand side in the economy to put the inflation in their target level. First of all, you should understand that every central bank, each central bank all around the world have a inflation targeting regime, and they are trying to adjust their monetary policy implementation according to inflation targeting and gross domestic product cycle, business cycle. For that reason, by the way, there is lots of people supposing that high inflation is not good. This is true, but too low inflation is not good as well, because high inflation is worse off the consumer side, but the lower and lower inflation, like deflation, maybe minus inflation, making the producer side worse off as well. If you are a producer and every day the prices is going down, you don't want to produce anymore. So if there is no production in the economy, there will be no growth as well. So to deal with the inflation and to adjust those inflation in the targeted level, we will try to cover what happened during the global financial crisis and 2020 COVID crisis, COVID pandemics, and how the governments and central banks try to solve those issues in the problematic side, especially in global macro indicators. First of all, as you see, I think somebody is moving their mouse on my screen, and it is not good. If you stop your mouse or screen and just follow the presentation, it will be better. Because when you put your mouses and pens on my presentation, I couldn't move. Okay. As you see here, in the global financial crisis 2008 and the COVID pandemic, policy rate. And what we are trying to say, I think the same is happening. Can everybody stop their mouse moving on my screen on the presentation?
Yes, we can see it.
As I said, on the left-hand side, we are seeing the financial crisis before and after financial crisis, global financial crisis, policy rate. Policy rate, what do you mean by policy rate? Policy rate is the global, actually local and global funding rate of the central banks to the economy. What do you mean by this? As you know, each central bank has an authority to print the money and to decide what will be the cost of this money in the economic circulation. So in your central bank, for instance, let's say you are in Jamaica or Kenya, or let's say you are in Latin America. When your central bank print the money, they will give the liquidity to the private banking system. Okay, loan deposit banking system, trade banking system. And they can also have an eligibility to decide what will be the cost of that funding. Okay, you can decide if you are central bank, you are the lender of the last resort. Okay, you are the lender of the last resort, and you can decide what will be the cost of that money. Okay, because you are the owner of the money. You are the only power that can print the money in the economy. If you are central bank, for instance, JP Morgan, Goldman Sachs, or Morgan Stanley cannot print the money. They can just get the money from the central bank, their central bank. Okay, this point is important. You should understand the starting point first of all. The power at the hand of the central bank, okay, to print the money. And if you are the owner, you can decide the prices, what it will be. Okay, then when you give the money to the liquidity in the market, then each private banking system can decide how much they put their revenues on the cost of money, and they will sell it as a loan. Okay, first, let's say the bank A in your country, in your city, get the liquidity from the central bank. Okay, it is the original money. Then they can sell this money by putting additional profit on it. And the original money coming from the central bank, the cost is policy rate. Okay, policy rate means how the central bank funding the economy and what will be its prices, the cost of money. Okay, and as you see, before the global financial crisis, the cost of money, for instance, these are the countries like United States, ECB, here is Japan, here is the Scandinavian countries, and approximately the average is around 4%. What does this mean? Before the pandemic crisis, if any bank in the system want to borrow from the central bank because they need liquidity, they will give the loan. They want to make profit. And while they are giving those money, they are paying to the central bank for the yearly 4% approximately on average. But after the global financial crisis, as you see, all the levels converge to zero. Not just the emerging market economies does not move and converge to zero, but all developed economies converge to zero rate. And you will see the same on the right-hand side of the COVID pandemic crisis. It is also before the COVID pandemic, it is above the 0%. And now, during the pandemic, it is today during the pandemic crisis, the policy rate is zero. And here is zero as well. First of all, you should understand the main topics. Why central banks decrease their interest rate during any type of crisis. This can be demand side crisis or supply side shock as well. Even each side of crisis, all central banks, the conventional central banks like European Central Bank, like United States Federal Reserve Bank, or the Bank of Japan or Bank of England, all central banks try to decrease their policy rate to the zero lower bound. What is the main target and triggering point behind this idea? You should understand first this topic, then you can solve the equation of monetary policy reaction throughout the world, because monetary policy is an implementation to adjust economic balance between the prices, employment, and gross domestic product growth. So if you have the power, you can adjust those policy implementation. And our first question is this: why the central bank decrease the policy rate to the zero lower bound? As you see here, zero, here zero. Why they are decreasing their policy rate to the zero lower bound during any type of crisis? It can be financial crisis like in 2008, and it can be the COVID-19 pandemics that happened in the 2020 throughout the world. Look at this picture, please. Assume no lower bound, that there is no lower bound in the economy, meaning that you can decrease the policy rate even minus. So the central bank giving the money, when you are paying the money, your loan to the central bank, they're paying to money. You are not paying additional, but they are paying you additional money because you are paying. You are in the maturity of the loan, you are getting the additional money. This is dramatic. This couldn't be happen in the modern monetary policy system. So, as you see here, the nominal interest rate, the blue line, should have a zero lower bound. Okay, the nominal interest rate can decrease only on the zero lower bound rate, but the real interest rate is a little bit. So you should also get the assumption of what we mean by nominal and real. Okay, nominal is gross and direct prices. Okay, when you see on the bus, when you see on the supermarket, when you see on your salary, it is gross salary. Okay, this is direct, the declaration of the prices, nominal changes. But if you adjust and if you convert those changes and according to the price changes, this will be the real. So from the nominal, if you adjust and transform the price changes from the nominal prices, then you will reach the real price changes. As you see, if we are here in the zero lower bound and if we have the positive inflation in the economy, this means that the real interest rate will be the minus. Why? Because the nominal interest rate is zero, but inflation is here, let's say 3%. 0 minus 3 is minus 3. So the real interest rate will be minus. Okay, so nominal interest rate as a privilege, as a basic assumption that it should be top at the zero lower bound. But because of the price changes, zero lower bound can be changed according to the real interest rate topics. And output gap. What we mean by output gap, this topic is also important because while we are changing our prices, let me show you something here if I can have a chance to take those pictures from the Bloomberg. I will share my Bloomberg screen, then you can see what we mean by the Taylor rule, output gap, and nominal interest rate. This topic is important. Let me put it on my screen. Hang on a sec. This is the password. Here we are. I'm sharing my screen. Hang on a sec. Here we are. This is the United States Taylor rule. I'm sharing my screen to reflect those changes. Let me expand. How can I achieve this? Yes, now I should stop the presentation. I changed my screen for the, yes, here we are. Look at the screen, please. This is the Bloomberg, and you can see from Bloomberg how the Taylor rule estimates the natural implementation. Wait, I should close this small icon. Yes, And now, as you see on the right-hand side, you see directly a graph. And this graph saying that current estimate of the Federal Reserve funding rate and the Taylor rule estimate is this. Please look at the calculation below. It is saying that we have a nominal inflation, we have a core inflation. In the below side, we have an inflation target, the actual inflation minus target inflation. And today, the actual inflation is 4.24. And the target inflation for the Federal Reserve is approximately 2%. And we have a sensitivity of the inflation to the nominal interest rate, and its alpha is around 0.5. Then we have the Ocon law, the Taylor rule estimation of Ocon law. What we mean by the Ocon law? The beta factor and Nairo. Nairo is non-accelerating inflation rate of unemployment. What we mean by Nairo? Nairo is directly saying that when we try to increase the GDP growth in the economy, we don't want to accelerate unemployment rate as well, because unemployment rate and inflation rate has a counter-cyclical indicator in the economy because of the Phillips curve. So you cannot increase the inflation, or you cannot decrease the inflation by increasing the unemployment rate in the economy. So if somebody asks you if every central bank can easily decrease the inflation, why they don't want to? Because if you want to decrease the inflation rate easily, the cost of decreasing inflation rate, it is proportionate to cost, will be the higher unemployment rate in the economy. Okay, if you don't produce the value additional product in the economy, the decreasing inflation will create a higher unemployment. And Nairo here, non-accelerating inflation rate of unemployment, meaning that the threshold value, break-even point for the inflation and unemployment, while we are making the vice versa. We are trying to increase the interest rate and decreasing the inflation, but until one point, the unemployment rate not increasing. But after some point, if you're decreasing the inflation, after that point, the unemployment rate will be rise. So the Taylor rule here, I think in the chat side, something is coming. So I'm proceeding my presentation. Then in the question side, I will reply those questions if it is for me. As you see, for instance, let's say change this, remember this number. For instance, current Federal Reserve rate fund rate is 5.5, but the Taylor estimation, it should be around 8%, meaning that the Federal Reserve is still below the Taylor estimate while funding the market, because they are saying that the inflation and the output cap is higher. For that reason, to decrease those output cap, we should increase the interest rate more. Okay, let's change, for instance, this one for the United Kingdom, and you will see the graph will be changed. And as you see, the current Bank of England rate is 5.25%, but Taylor rules saying that it should be 13%. What does this mean? The Bank of England still not prudential for the funding rate, and they are feeding the inflation in the economy. If this current rate converts to the Taylor rule estimate, inflation will go down more. Okay, so if this gap is higher, inflation still will be higher as well. So let me turn back to my original presentation. Let me share my screen again for the original presentation. Here we are. As you see, this is our basic starting point. Assume we don't have no lower bound and we have output cap here. This output gap, inflation and real interest rate, is directly produced from the Taylor rule. While sharing screen, I want to show those Taylor rule estimation, how they are making policy rate and the Taylor rule estimation, rule-based economy, rule-based monetary policy, the Taylor rule. And look at this. This is no lower bound in the economy. And look at this one. The next slide is average inflation targeting. What we mean by here? When we have nominal interest rate here, as you see, the nominal interest rate will gradually increase, and the real interest rate will first rise up, then go down. Why? Because if we are here in the nominal interest rate is zero lower bound, then if we produce the positive inflation, the real interest rate will be a little bit go down. But then when the nominal interest rate is rising, the nominal interest rate rising, the real interest rate is rise as well, as you see here. Okay, but the inflation, because of the crisis period, inflation will go down. Okay, there is no inflation. During the crisis, there is no inflation. The reverse is happening. The deflation, the prices is going down. And you are trying to converge, those inflation rate, because it is here first, and the crisis start and it is going down. And you are trying to converge those inflation to the targeted level, because target is here. But because of the crisis, because of the pandemics, because of the financial crisis, the inflation rate directly going down, and the central bank interact the markets here and converge those inflation rates as you see here. As you see in this point, the crisis starting, inflation going down, and here at this point, the central bank intervened to the market dynamics and trying to increase those inflation to the targeted level. Okay, the basic dynamics behind this pictures and graphs following this idea. And look at this picture, please, because while we are saying the inflation, we are directly speaking about the consumption side economy, because you know that the basic output equation is saying that the output equals to consumption price, investment price, government expenditure, and then the export. And this is the contribution. This is the subcategories of the output, gross domestic product. And the consumption, one of them is consumption, investment, government expenditure, and net export. And when we are saying the consumption, it is approximately 70% of the output. So the investment, government expenditure, and the net export is just 4 of them, 3 of them. It just consists of 30% of the global output, but the consumption is 70%. So when we are trying to speak about how we can solve the inflation problem, we are trying to solve the consumption problem. Okay, if nobody consumes, there will be no inflation in the economy. If everybody consumes, the inflation will go up until the infinity. If everybody increase their consumption and their demand, the inflation will go up. And what the central bank trying to do during the global financial crisis or pandemic crisis, they're just trying to trigger the consumption. Okay, you should advocate the consumption, and you should persuade people to consume more, to create inflation. Okay? Because nobody is going out, nobody is consuming, nobody is spending, consumption going down. But as the central bank decrease their interest rate, loan rate, as you see here, remember this, as they decrease their policy rate, because money is cheaper now, everybody wants to consume. Okay, if I say today the interest rate is 80%, nobody go to the car sales and buy a new car, because the loan you should pay after 1 year is, if today 1 million, the next year it will be approximately $2 million, and nobody will buy that loan because of the high rate. And if nobody get that loan, don't have enough money, and nobody buy the cars, and car prices will go down. So if the interest rate goes up, prices will go down. This is basic dynamics in the economy. Okay, so look at the picture again. As you see, the private consumption during the pandemic, look at here, nobody consuming and consumption shrink, approximately 10% of the GDP. Okay, nobody is going out, nobody consuming and spending the money, and the consumption going down, and inflation going down as well. Okay, this is the basic dynamic behind the how the crisis period decreased the private consumption in global financial crisis and COVID pandemic. And right now, after the central bank increased their interaction to the monetary policy, when they decrease the policy rate to the zero lower bound here, then everybody start to consume more. Okay, consumption is increasing. So the basic dynamic here is I want to trigger the consumption because it collapsed during the crisis period, and I'm decreasing as a central bank the price of the money, policy rate, then everybody consume more, and I am converging the inflation to the targeted level. And here on the right-hand side, yes, by the way, I'm seeing the chat side simultaneously. And can you send us this presentation? Yes, I will share the presentation as well at the end of the session. And here, as you see, more goods, less services consumption. What does this mean? We are trying to get the basic foods, basic needs. Okay, nobody going to the restaurant, nobody going to the hotel, nobody going to the travel. Okay, this is services. But I am focusing on my basic needs like water, like bread. Okay, I'm just want to alive. And more goods consumption increasing, but less services consumption. Nobody going to the coiffure. Okay, to make their hair better. Because my priority is to be alive, not to be handsome or beautiful girl. Okay, handsome man or beautiful girl. Our priority is during the global financial crisis is to be alive. And for that reason, we are converting our structural consumption cycle from service to the basic goods, basic needs. And goods consumption increasing and the services consumption decreasing, as you see here from the picture. And the decline in the GDP. This graph is also important. When we are trying to show this historical decline in the GDP, look at the different areas, US, Euro area, United Kingdom, Sweden, and mainland Norway. As you see, during the COVID crisis, first quarter, as you see, the light blue is the first quarter and the dark blue is the second quarter. Both quarters, they both have shrinking. But in the second quarter, the shrink level is a little bit higher because after the March of 2020, in the second quarter of the 2020, we see the economy shrink more and more. And when we see how they react to those changes in economic cycle, you will see this one. Look at this picture, please. As you see, the consumption decreasing, GDP decreasing, and now the microphone at the hand of the central banks because they are the higher authority in the economy. And what they are doing? Central bank balance sheet have expanded. As you see, the dark blue is Federal Reserve, the light blue is European Central Bank, orange one is Bank of England, and the purple one is Riksbank, and red one is Norges Bank. These are the developed economies, how they react to the COVID pandemic crisis. And what does this mean? The central bank balance sheets have expanded. By the way, these numbers are showing how the central bank balance sheet consists of the GDP. So if we are saying, okay, this means that the European Central Bank balance sheet is approximately 60% of their GDP. This is huge, okay, higher than half. So in the central bank asset balance sheet side, we are buying lots of treasury bills and government bonds from the market, and we are giving cheaper and priceless money into the economy to trigger the consumption level. As you see, look at here. What is my priority? My priority is increasing inflation, because inflation is going down. But while increasing those inflation, I don't want to be the Nauru level. Okay, after some point, if my inflation level is above the targeted level, then I will start to quantitative tapering period. This one, as you see, look at here. This is 2008 prices. Okay, and as you see, there's a huge rise. And as you see here as well, this is the COVID crisis, the increased expansion of the central bank balance sheet. And what is my main point? I want to increase inflation to the targeted level, but I don't want to increase those unemployment rate as well. Okay, unemployment rate should be in the Nauru level, a non-accelerating inflation rate of unemployment. So these two operations here, this one and this one, increase in the central bank balance sheet is the quantitative easing. Okay, central banks buying the government bonds and treasury bills from the market, giving cheaper money, and they are increasing their balance sheet assets. And here, unemployment rate, as you see during the global financial crisis, and no global financial crisis, but directly during the COVID pandemics, the unemployment rate, as you see, converged to the 10%. This is huge for the developed economies. Normally, it is around 3 or 4%, the unemployment rate. But right now, during the COVID crisis, the unemployment rate reached to the 10%. And here, as you see, this is the GDP. When the GDP goes down, no production, no industrial production, no economy, and unemployment will go up because everybody will be laid off. But if economy produce, GDP is high, increasing, unemployment rate will decrease as well. So you can think directly as GDP and unemployment rate is a counter-cyclical changes because of the Ockham law you see in the Bloomberg presentation. They are counter-cyclical. When the GDP rise, unemployment rate decreases, or vice versa. There's a question here. I think, let me answer this first. Money seems, and Dr. James Key asking this, money seems and is the driving force in the decline. I saw where services was lower than goods during your presentation. Does not demand drive the gross domestic product? No, because during the crisis, especially like the COVID, nobody is going out. Okay, nobody is on the street. Nobody is going to the restaurant to drink beer. And drinking beer in the restaurant is a services product, not the goods. But rather people just going to the kitchen and they are buying the bread. Okay, bread, water, basic needs, not the luxury goods. Going outside to drink coffee is luxury at those times. And the services demand decreasing, but goods demand increasing during the crisis period. Okay, if we are in good times, if everything is normal, people can increase their travel, consumption, spending, hotel spending, going outside, dinner, and those side can be increased because of the services sector can be normal. But during the crisis period, like especially with COVID, nobody is going out from the home. We can only see the goods demand is increasing. Okay, I think this answer is enough for you, Dr. James. If it is not enough, after the session, because I will give. Okay, Abdulkadir Kamara asking this question. Could you explain the interconnection between inflation, interest rate, and unemployment? Good question. If you understand this relationship, you can understand everything. Okay. What we mean by inflation, interest rate, and unemployment. Just think this. There is an interest rate here. Let's say this is 10%. Okay. And you want to buy the money, you want to buy the car, or you want to buy the house. Okay. You are going to the bank and you are asking that you need $10 million. And they are saying that the interest rate for $10 million is, let's say, 5%. Okay. Meaning that you will get $10 million, but at the end, you will pay approximately $10.5 million, right? This is basic relationship. But you are thinking this, you need a home, you need a car, your salary is good, and just 5% repayment for the $10 million is okay. But if the bank say to you, now the interest rate is, let's say, 80%. This means that if you get $10 million as a loan from the bank to buy house or car, you will pay $18 million. 18. Okay. 10 you are getting, and you are paying $18 million. And you are saying this question to you. I'm getting 10 and I'm paying 18. This is a huge cost. And you are not applying for the loan because interest rate is higher. Because interest rate is higher, you don't want to get the loan. You don't want to buy the car. You don't want to buy the house. If you don't want to buy, and if you don't buy those things, there will be no demand for those things and their prices will go down. Okay, so if interest rate is higher, inflation will go down. Okay, this is basic dynamics. If interest rate is higher, inflation go down. And if so, interest rate and inflation is reverse related. And if the inflation is go up, the unemployment will go down as well. Okay, this is reverse idea as well. Inflation up, unemployment go down, interest rate go up, inflation go down. Okay, I think la main camera, this explanation is good for you, but if it is not sufficient and satisfactory for you at the end of the session, I will turn that question again as well. And here we have central bank policy rate, and look at this one. During the global financial crisis and COVID crisis, we are in the zero dollar bound. Okay, this is zero, meaning that you are getting the money and there is no cost for that because you want to produce inflation. All central banks want to increase their inflation, okay, because there is no inflation in the economy. There is no consumption in the economy. They are decreasing the interest rate and they want people to consume more, create inflation, okay? And as you see here, we have market expectation for central bank policy rate. What we mean by this? This is directly saying that if you decrease the interest rate, inflation will go up. But sometimes inflation can go up more than your targeting level. And if you are increasing those inflation more than your targeting level, after some point, you will increase interest rate to decrease those inflation as well. For that reason, you will now have a higher policy rate implementation because they are saying that you are in zero, but you are here now, here, okay? And they are saying that, for instance, the United States, the black one, will be here, let's say 5.5, but they are supposing that they will decrease at the end of the 2023. But now, no, there is no market expectation that the Federal Reserve Bank of United States will not decrease their interest rate. And here, as you see, central bank balance sheet we have. Look at this one. Here we have central bank balance sheet in 2008 crisis. From approximately 1 trillion, it is going up 2 trillion. And during the global pandemics, as you see, here we are and we are increasing. Why? Because we have crisis, central bank give cheaper money and they buy the government bills and treasury bills and government bonds from the market, okay, to increase the consumption and inflation in the economy. And you can see here, this is the different structural side of the what is buying from the market. For instance, this is treasury, this is mortgage-backed securities, MBS, mortgage-backed securities. Others are black, and the loans, they can buy the loans from the market as well. And this is the total asset. And as of nominal GDP, and look at this Eurozone. Eurozone central bank assets approximately 70% of their GDP. This is huge. This is extremely huge money. And they are trying to trigger the inflation in the economy. And as you see, what is my priority? My priority is this. Here I have a huge increase in the unemployment rate during the pandemic, right? And I want to decrease those unemployment rate by increasing the inflation. Remember the relationship between inflation and unemployment. If unemployment go up, inflation will go down. And central bank will come to the market, they will increase the inflation and will decrease the unemployment. Okay. And you should look at this slide as well. Labor market supply here and demand condition. Here we have ratio of job openings. And what does this mean? How the job owners seeking new employment opportunities in the market. And here during the COVID, it shrink approximately from 1.2 to 0. Then central bank comes. They increase they decrease because of decrease in inflation. Now the job openings will go up. Okay, we have more opportunities in the market to get an employment condition. And look at this one, this left-hand side. This light gray line are the recession period. Recession means when we say officially a recession, the economy means that 2 consecutive quarters decrease in the GDP, meaning that this quarter the GDP shrinking and the next quarter GDP shrinking as well. This is directly a recession in the economy. And today we are speaking about the recessionary period in the economies, even in China, even in the United States. And when you look at the probability of recession, I will share my screen as well. Look at this screen now. Let's look at probability of the recession in the economy. Look at this one. And let's look at this one for 5 years. And as you see, during the COVID crisis, approximately 100% of recession, because economy is in the recession. 2 consecutive quarters, we shrink in the GDP. And now, because of the increase in the interest rate, nobody wants to get the loan as well, and there is no consumption, and inflation will go down, and we are speaking about the recessionary effect in the economy as well, but still we are far away from the COVID crisis period because it's approximately 100% at those times, but today it is 60% just. And let me turn my presentation again. Look at this picture. Eurozone GDP and inflation. We have left-hand side a GDP. And look at this one. This is directly a collapse in the GDP because of the COVID crisis. No production, no consumption, no inflation, no GDP. Okay. And after that, as you see here, central bank buy the asset, give the money market, and then GDP will recover its original level. And when you see this picture, as you see here, we shrink 2 times, 2008 global financial crisis and 2020 COVID crisis. This is the GDP shrinking consecutive periods shrinking. And when you see the average growth rate is around 3%, 2% for the European Union. And this is just the base effect because you shrink, even you increase 1%, we seem like 10% because of your after shrinking base effect. But now here, when you see the average line, it is still above the trend line. So the Eurozone GDP will converge to its long-run trend by decreasing and pricing the recessionary effect in the economy. And inflation, this is what we look for directly. During the COVID, inflation shrinking to zero, and European Central Bank come to the market, increase the central bank asset, and increase the inflation approximately to 10%. These are the real economic activities. When we speak about financial market activities like FX market, like stock exchange, like interest rate, these are the financial market indicators. But when we speak about the export in those industrial production, this is real. We can hold this at hand. Okay, this is not a dream world. This is directly a kitchen. We can see what we are producing in the kitchen here as well. And retail sales and consumer confidence. As you see during the COVID crisis, it is shrinking. And after the central bank intervened to the market, it comes to the higher level than average condition. And one of the most important, maybe today the most important country in the world, China. If the China increase their demand, the world economy increasing and growing. But if China decreasing, even Bank of England, even European Union grows, the world economy shrinking because of the Chinese population and hegemony of the world macro indicators today, with 1.5 billion population and with a huge, approximately $19 trillion gross domestic product, the China an unprecedented effect on the global economy today. And as you see, in just one quarter, and then they are still growing. China is the motorcycle of the growth in the world economy. And the last presentation here, directly showing the financial dynamics. As you see, the RMB index, this is directly showing the USD Chinese yuan, the FX rate. And Chinese yuan, because of the currency war in the world, trying to depreciate by the Central Bank of China, People Bank of China, because they are exporting country and they don't want to huge appreciation in their domestic currency. They want to depreciate their currency because they are collecting the reserves with euro and United States dollar by selling the goods to the rest of the world.